One thing about property taxes is it's the government subsidy for not having state income tax. They're going to get taxes one way or another.
You want to have a lender that understands those dynamics. I mean, let's be honest. We've all seen some weird, shady lenders that do some weird things, and you're like, that it doesn't make sense. You're not putting the client in the best position for them. And so that's why, again, when we do a ton of new construction, I would much rather you have a lender that understands that space, understands the appreciation, and understands the best value for the money that the builder's giving you. Hey, y'all, welcome back for another episode of the DFW New Homeowner Podcast. Megan and I are here. We have a special guest with us today. We're going to introduce you to Jared. Jared is one of our favorite lenders to work with. Personally, he's closed a handful of my own loans and, of course, a ton of client loans. So when it comes to new construction lending and mortgages and questions, Jared is probably the best person on the planet to work with when it comes to things like that. So, Jared, thanks for hanging out with us today, my friend.
Absolutely. Glad to be on here. Thanks, guys.
Give us I gave you the intro. Give us your 30-second, like how long you've been doing mortgages, all the fun stuff with that.
I started back in mortgages probably 13 years ago. I started with Loan Depot. So I was in a call center. Quickly realized that that was not the place for me. Understood mortgages, but just it wasn't the right fit. So I went to a company called Service First Mortgage. A great friend of mine was a manager there, recruited me over there, and I've spent 10 years there. And then a year ago, made a switch to Benchmark Mortgage, just kind of focus on growing that builder relationship.
Yeah. So your primary role is new construction lending right now.
It is. And I got into that world, strangely enough, when you're in your role as a realtor, and you're in my role as a lender, there's two types of, I guess, business models. There's market share or client share. Mm-hmm. Market share is, man, I'll take 100 deals from 100 different people and just whatever it takes. I was always more of the client share. I would rather do 10 deals with 10 agents or 10 individuals that I really enjoy doing business with. Same 100 deals, just now I can focus my efforts on those specific people. And that parlayed into builder relationships where you can work with a builder, their team, and help a lot of people, but really dive deep on the personal relationship side.
Yeah, that's awesome.
Yeah. And, just so you guys know, you guys know that I came from Pacesetter, home builder, and Jared is one of the recommended lenders for Pacesetter. So Jared and I have done hundreds of deals together.
Lots.
And I can definitely speak to that when you have someone that you're used to working with, that you have trust, that you have strong lines of communication with, things tend to just go a lot more smoothly, and it makes everybody's job and life and the loan process way easier.
Yeah. Well, and I think too, and Jared, I'd love for you to speak to this. Like, I've had clients ask me before, they're like, do I have to use the preferred builder lender? And my answer is always no, you don't have to do anything, right? But most of the time you're going to get majority of your incentive money is tied in-house lending. And so some people are scared of in-house of builder lenders. They're like, oh, they feel like they're going to take advantage of us, or they feel like we're not going to get the best deal. I'd love for you to speak to that. Like, help me with those fears.
I like to use a lot of sports analogies when I talk about stuff like that. You could put any 5 people on a basketball court and play basketball, but it takes a special 5, a special team, people that know and can depend on those other people to win a championship. So when it comes to the builders world and builders lenders, they have their championship teams. It doesn't mean that we're better or worse than any other lender, but they are familiar with our processes. They're familiar with our underwriting guidelines, whether we're uber conservative or we will find a way to help people that need help. They have preferred title companies for the same reason. Yeah. It's not just who's going to get them closed and do the paperwork, but there's so much behind the scenes in title for the deed restrictions, for the plats, the surveys, all of the HOA stuff that goes in. So from a lender and a preferred relationship, it's just a partnership. It's a trust. And there's other things that go with it. Probably one of the most common is appraisals. So we use the same appraisal management company. It's not the same appraiser every time in every community, but over a decade of building in 10 or 15 different communities, you tend to have the same appraisers go out, and they're very familiar with the market. They're familiar with how the builders price when they increase their prices. And you're going to generally have a consensus of or understanding that those homes will make value because they're familiar with that builder. They're familiar with the sales process. They know what has sold or what's sitting in the backlog that will come out. They just know that. They're familiar with it. So you tend to just get a full package when you have reliable partners.
Yeah. And that makes a difference. That makes such a difference.
And, I'll tell you to your point on the cost, or, I'm not going to get as good of a deal. I would say that when you look at it in its entirety, somebody that's going to build a home and that relationship with the builder, the buyer, salesperson, agent, lender, that's going to span 6, 7, 8 months.
Yep.
The normal mortgage process is 30 days. It's to buy a home that exists and it's ready to go. So that 30-day process literally has to happen 2 or 3 times during that new construction. First 30 days, we got to let the builder and everybody know that, yes, these guys are qualified. They can close. They can afford the home. Everything's great. Assets are in place. Everything's there. Then if that person has any challenges or opportunities, let's say, where we can make improvements, we're going to help them with that. And we're going to review it every 30, 60, 90 days. Then the last 30 days, we have to go through the complete cycle again to make sure nothing's changed financially. Jobs haven't changed. People still, have the same amount of assets. They didn't go buy a car, all that kind of stuff.
Right.
So when you look at the costs, overhead for a lender to manage or work with a builder, there can be slightly higher costs. The builders understand that. And that is the primary reason they have incentive dollars when you use their preferred lenders. They're like, look, we understand the process. We trust the process, but there is some additional overhead. And they don't want the buyer to pay for that because the builder still benefits from that whole process. So they cover that cost plus additional incentives to make sure that it's worthwhile to use their preferred partners.
Yeah. And I think that's what makes the process work so smoothly. All right. So we got to talk all the things. So you do mortgage lending, pull your crystal ball out. Sure. Tell me when I'm getting a 3% rate again.
If you had said, when will I have lower rates? The answer to that is pretty soon. Yeah. To put a 3% line in the sand, I don't know. I don't know. It could be decades before we're back to 3%. It could, but I don't think it will be that long before we see pretty substantial improvements from where we are right now. And that's historically presidential cycles have improved rates going into third and fourth quarters. The market itself is doing better. If you believe what the Fed says and all the stuff that's out there now, they're holding on to those inflations and keeping the market where it's at. It's manipulation, not in a malicious sense, but they're holding it in a holding pattern. Whereas if they just let go of the reins, we would see better rates in the next 90 days. Yeah.
Do you think, and Megan and I have talked about this a little bit, but I'd love to hear it from the lending perspective. You think as rates normalize, builders will pull back on their incentive money?
Yes and no. Yes and no. I do think that they will, because right now there's kind of a balance in buyers' perception on sales price versus incentives and rates and closing costs and all that stuff. And, the consumer's mentality is that I have to have a lower price. Well, right now, builders aren't lowering sales prices. They're giving concessions to make homes more affordable. When rates start to go down, the affordability will become easier for people anyway. So builders won't have to offset that. And I think you'll start to see some small pullback on the concessions. I do.
Yeah. So talking on that, Jared, some people are like, okay, yeah, I want to get $20,000 off the price of my home. Talk us through, let's say it's a $400,000 home. Is it better for them to take $20,000 off the price, or is it better to take $20,000 in incentives and buy the rate down?
I've got a pretty strong opinion about that. And it would go back again to kind of the consumer's mentality. When you go buy, I don't know, a shirt or an outfit or a suit or something, and it's on sale, you immediately feel that savings. You You see that immediately because it's a one-time transaction and it's done the minute you leave the store. So $500 on sale for $300, you save $200 today walking out. On a mortgage loan that's amortized over 30 years or 15 years or 20 years, you don't ever feel that immediate savings unless you take the money today, whether that's through interest rate reduction or closing cost incentives. To your example, Megan, $400,000. Somebody wants to put 10% down, that's $40,000, and say they've got another $20,000 in costs. That's $60,000 that they're going to write a check for. Yep. If you take the sales price down $20,000, now it's $380. That $40,000 becomes $38,000. It's $2,000. They saved $2,000. But if we take that $20,000 as price concessions and it goes towards closing costs, now instead of $60,000 at closing, they're just bringing $40,000. That's the only way in that transaction that somebody will literally save the money today, immediately. You can compound that if you put it into interest rates. But in this market where things are going to fluctuate, I think you'll see opportunities to refinance and save on the monthly side in a short period of time. Whereas that $20,000, once it's saved or spent, it's gone. It is. It's just gone. The only way, in my opinion, to really feel it today is to take the money today. Don't lower the sales price. You're going to get the same equity. You're going to pay your balance down. When you go to sell the house in 5 years, you won't notice that $20,000 anywhere. And if you think, well, I want to get $20,000 in equity later, you already got that $20,000. You got it today.
Yeah. Well, and I think your point is valid. You're going to sell it in 5 years. Nobody's holding property for 30, right? No. And if you are, you've refinanced it 3 or 4 times. I will say the thing that stresses me the most is, so like when we're sitting at the closing table and clients are signing all of their documents and the lenders, you slip in, you have to do it, the amortization schedule. And it's like a 5-page document, and you start looking at, you're like, oh, if we paid this out over the life of the loan, it would be a stupid number. Yeah. Right. And so I think that closing costs now makes more sense. I always tell people we want to control the asset for as little of our money as possible.
Yes. 100%. 100%. It's the same thing, for investors, if you look at it in terms of, because it's the same mentality. I want the lowest rate, the lowest everything. But that monthly cost is really being passed on to your tenant. It's how fast can you get into a property and how inexpensive. I'll take a higher rate for the lower costs every day, because when the rates come down, I'll refinance. Someone else is going to cover most of that cost, if not all of that cost. I want the lowest cost out of pocket for everything I do.
Yeah, I agree. So one of the things that hits a lot of people, and I have this, and I'm sure Megan, you have this too, is we pull a lot of clients from out of state that because DFW is a hotbed for growth, development, all of those things. And I think one of the things that shocks a lot of people is the amount we pay in property taxes, right? That number gets expensive very quickly. And so from a mortgage perspective, you have to calculate that as part of their debt to income, correct?
We do. Yeah.
And so that makes it hard. So you walk in thinking you can afford one thing, but realistically, I mean, property taxes probably drops your affordability by what, 40 grand, 50 grand ish?
It can. It can. Yeah. The one thing about property taxes is it's the government subsidy for not having state income tax.
Correct.
So when you understand that, they're going to get taxes one way or another. What you'll see in the taxes, and it is a little bit higher than some other areas. You're right. Some high areas in DFW are 2.5, 2.6, 2.8. If they've got some municipal districts or improvement districts, that's a big percentage of your monthly budget when it comes to housing. It is, but it's a subsidy for not having state income tax. I will tell you that as your property values go up, your tax percentages in those areas generally start to come down. A lot of people don't know that because, like you said, you're gonna sell the house in 4 or 5 years, 6 years, 7 years. But if you look at an area where it's 10, 15, 20, 30 years old, you'll see that as those home values go up, the percentages of the taxes come down. It's the same dollar amount going back to the same cities and municipalities, but now a lower percentage on a higher value is going to be the same amount of money out of pocket. The lowest tax area we have in DFW is Highland Park and Union Park, because you're looking at multi-million-dollar homes, and 0.5% in tax on a $5 million home is still a substantial amount more money than 2% on a $400,000 home.
Yeah.
Yeah.
If we ever get to the point where we abolish property taxes, I would vote for that in a heartbeat. I don't know how we do that, but I would vote that way.
I'm nervous of the consequence. Where do they get their money if it's not there? But I agree. Or a cap somewhere. A cap on. Your homestead has some benefits to it, but a cap on age or a cap on a certain dollar amount or percentage, I would absolutely be for a cap.
No, I agree. Megan, what do you think? Like, and I think this is a question for both of y'all. What in terms builders structure their incentives a ton of different ways right now, right? Like we have some builders that say, hey, here's a flat $20,000 in flex cash, and you can use it however you want to use it. We have some builders that are saying, oh, we're buying a 3-2-1 rate. Like what perspective wise, what would you rather have? Like if we could do this, like from a lending perspective, from another salesperson's perspective, what would y'all rather have as incentive on the table?
It's a little tricky because I feel like some people prefer the simplicity of that. It's weird. Like my views of this have shifted a little bit going from sales to being in real estate. I feel like in sales, like being the salesperson and having to explain a really complicated incentive structure, I found that a lot of people would just get glazed eyes when I would try and explain it. But then I think there's more tangible things that people, especially first-time buyers, if you're saying, hey, you get fridge, blinds, washer, dryer, and no closing costs, people really feel that up front in their pockets. Or if we say, hey, like your interest rate's going to be way lower and your payment's going to be way lower. I don't know. I feel like I'm rambling about this a little bit because I don't have super firm opinions on it anymore like I used to. But Jared, do you want to, what do you think about that?
Yeah, I think it's dependent on each buyer and their situation.
Definitely.
Like I said a minute ago, I think that taking any incentive up front and immediate is going to be the best option for most people. And I would say most is in like 90%.
Yep.
A buy down like the 3-2-1, for people that don't know, it's a subsidy. So it's not an actual reduction on interest. It's what's the difference between interest that they're offering and interest that you get, and they'll subsidize that payment.
Yep.
So if a builder is going to put $15,000 aside in a subsidy and give it to you in smaller increments over 3 years, like a 3-2-1 buy down, there's no compound factor to that. At the end of it, you just got in small increments the $15,000 that they set aside for you. I want that $15,000 today because I can do more with it on my own than in small pieces over 3 years. There's no compound factor.
Yeah.
If you're looking to buy your interest rate down permanently, then there's a compound factor there. So I know that they solve an immediate affordability thing for people and getting into a home where the first couple of years you can ease into a payment, but there is no actual benefit to it. It's just somebody holding the money and giving it back to you in smaller increments.
I think that's a really good perspective on that, because even in that, like you still, and I tell clients, I'm like, you still have to be able to qualify at that higher rate, and you're taking the gamble on what you think is going to happen in the market in 2 years or 3 years to potentially do a refi, right? And Jared, you and I talked about this a couple of weeks ago. There's a couple of builders that were advertising no down payment, no closing costs, and you start digging into the details on it, and it's like, oh, it's a 10-year forgivable second at 2% higher than market rate. And so the tension is like, yes, I understand getting into that home, but I think to your point, it's like, what is the long-term compound effect on that?
Yeah. Yep. And I will tell you, probably the biggest miss that most people in my industry have is that they don't look at time frame. They don't look at break even. I think that, buying your interest rate down, if it's someone else's money, if it's builder money, builder concessions, and it's not your out of pocket, that's a good option. But as an individual, if I start looking at, well, if I want to buy a lower interest rate and I want to spend $5,000, just a random example, I want to spend $5,000 to do it. If it only lowers my payment by $50,
what's the delta?
It's 100 months to break even. That's not a good investment. But if spending $5,000 saved me $100 a month, or or $200 a month or whatever it is. That time frame for break even is what a lot of people don't look at. They look at, it's just my friend has a lower interest rate. He bought 3 years ago. I have to have the lowest interest rate. I have to, because they assume that that's going to be the greatest savings. But if you pay for it and you're not in it long enough to break even, then it's not a savings at all.
Yeah, it's a detractor. Yeah.
Yeah.
Mm-hmm.
Yeah.
No, I think that's the hard part in all of those things. And again, I think this goes back to what we were talking about at the beginning. It was like, especially in the new construction space, you want to have a lender that understands those dynamics, because let's be honest, we've all seen some weird, shady lenders that do some weird things, and you're like, that it doesn't make sense. You're not putting the client in the best position for them. And so that's why, again, when we do a ton of new construction, I would much rather you have a lender that understands that space, understands the appreciation, and understands the best value for the money that the builder's giving you.
Yeah, because it's not the same for everybody, but it is important to understand each individual homeowner's goals. Is this a place where they want to raise their small kids and then downsize in 15 years? Is this a pit stop in their corporate careers? Is it just a 2-year space? There are people that want to build a lot of equity. There are some where the mortgage payment is just the cost of living and the cost of storing all their stuff, just a place to put and house everything they own. So understanding their goals will really help you dial into what's the best approach, because it's not one for all. It's not one thing fits everybody, but there are options out there for everybody, and there are good options out there for everybody.
Yeah, it makes it attainable. And then especially like once you start getting into those, specialty programs, I have a lot of people right now that qualify VA lending. And I know you've done several of those. And it's like, hey, if you can use a VA loan, like if you qualify and you've earned the right to use that, it's one of the best loan products there are, correct? There is.
I think so. No, absolutely. Absolutely. You can finance more. You can finance up to 100% of the home's price, 0% down. There's no mortgage insurance.
Yep.
VA loans don't use the same debt to income qualification or affordability qualifications that others do. They look at residual income. After you pay your mortgage, pay your taxes, they actually even have a calculator for cents per square foot for deferred maintenance. If you've got all that and still have money to live and survive, you can buy a house.
Yeah.
And I'll tell you, veterans tend to be a little bit more disciplined in most facets of their life. Finances is just one of those that carries over. So I would tell you that, I don't want to speak in generalities, but most veterans that take advantage of VA loans, that it has by far the lowest default rate out of any loan program out there, period.
That's awesome. Speaking of that, I was going to ask you this because I had a client asking me and I don't know the answer. So I have a client right now that we're buying with a VA and they have 100% disability, which means they have a property tax exemption, right? But yes, they're buying in a MUD district. So does that exemption carry to their MUD, or do they pay the MUD?
Nope,
really?
It does. Yep. So even though that MUD or PID is not essentially a property tax, it is a property tax. It's collected through the appraisal districts and through the county assessors as a tax. It's conveyed and levied as a tax. So they are exempt from those property tax collections as a 100% disabled veteran.
That's awesome.
Yep.
All right, I have a couple other questions. Megan, do you have any other ones for Jared?
I do have a question, and this is something I've been meaning to talk to you about anyways, Jared. And I know we have some realtors that watch this. We have some home buyers that watch this. So I think this will be helpful for both. As a new realtor, I want people to get pre-approved before we go out and start house hunting, because you don't want any broken dreams, broken hearts when they find the home that they love and they go to get approved and they can't afford it. They can't get approved for it. But in the new construction space, typically you have builders preferred lenders. So until you know what builder you're going to end up with, you don't know which lender you're going to end up with. And I feel bad asking a lender to do that work of getting a pre-approval when I don't know if that's where they're going to end up or not. Like what is your advice to realtors who are wanting to get buyers pre-approved looking at new construction? And what's your advice to buyers who are also looking to get pre-approved?
Just do it. Just do it. I think that having an understanding of the entire process, not just the affordability piece, because you would be surprised at the number of people that have the income required to buy a house. They can afford a house. Mm-hmm. They might not have the assets required to put down. They might not have the credit component to qualify, or that credit component might require, a waiting period or something. Maybe it's a student loan that's in collection and that requires 6 months. But if you wait 6 months to find that out, now you're finding it out 6 months from now that you need to wait 6 months when that time could have happened concurrently. So I would say pre-approval is probably the number one or number two step in the process. It lets you identify what the monthly affordability is. And I would tell you that I as a lender, I appreciate your sentiment on, I don't want to have somebody I work with do all this work to ultimately not help or get a deal. I would say that there's probably very few lenders that think in those terms. I think that we want to help people and educate people. The pre-approval process is not a complex draw on our time and resources and efforts. If you're a good lender, you're gonna see red flags or green flags immediately, and you can give that information and give that advice. I will tell you that when you give really good advice or invest a lot of time with somebody who needs it and help with that structure, sometimes the savings of a preferred lender don't overwrite the relationship or trust that they've formed. And that lender can still end up closing, even if it's at the same cost or even a slightly higher cost, because there's that trust factor. So I would say get a pre-approval right away. And something for everybody out there. We often get questions about, well, can I do a soft pull? I don't want multiple inquiries on my credit. There is no impact. If you're shopping, you can have 15, 10, 5, there's no number of lenders that can pull or review your credit in a 45-day period of time. So if you have one and they do all the work and they're like, perfect, this is your price range, go find a house. And then you talk to 3 or 4 other lenders through the build process, there's no harm in that. There's really no harm in that. And you'll find that we all have slightly different directions or structures on what we would advise. And you'll find that there's probably something that you'll go, oh, that's the perfect solution for me that another lender might not have. So I would say get it done early. You'll know and identify what your issues are, if there are any. If there's not, and it's carte blanche, go find your house. Yeah. Go find it.
Well, and I'll say too, because Jared's done this for me before. Like Jared is the preferred lender on a handful of different builders, but he's obviously, you're not for every builder. But there have been scenarios where we've worked with a preferred lender, and for one reason or another, we couldn't get the deal closed. And I've sent it to Jared, and we've been able to like again, like he was talking about, everybody has a little bit different programs that they can do, different overlays in terms of what you have to get through for underwriting. And when those kind of situations happen, builders will sometimes allow that money to move and give you more of that incentive. Like if you try with their in-house lending and their in-house lending can't get it done, but I can bring a lender in that can, they're usually a little bit more lenient on giving you more of that incentive money versus us just taking that from the start. Would you agree?
Yes. And again, like you said, if it can't get done at a point where a buyer's already under contract, they're going to be flexible with those dollars, because now their commitment is to sell the home. They've already figured that their holding costs are going to end at a specific time frame. If they have to relist it, now they extend those holding costs. They might incur additional costs, and those are oftentimes the same as what the concessions would be. So they're like, look, let's just get the house closed with buyers that really want to buy the house. They're committed to buying.
I want to ask about this one, because I'm seeing a lot of builders do this, and I don't know that consumers fully understand this, and it's that forward commitment rate buy down pool, right? So had some buyers over the last couple of weeks. We were looking at, I won't give you the builder, that's not important. But anyway, they were looking at a forward commitment rate buy down at like 4.9%. And they were trying to explain it to them. But at the end of the day, it was like, hey, there's only like one or two of these left. And it's like, well, what do you mean there's only like one or two of these left? So I'd love, like, talk me through, like, I think I understand that, but I would love for people to hear that, because I think more and more builders and lenders are moving to that sort of forward commitment style incentive.
Sure. So a forward commitment is where a builder will buy a certain amount of loan dollars at a very specific cost. So, you might be looking at a community where they've got 4 or 5 homes that are $200,000 or $300,000 or $500,000 in sales price. Well, they're going to, let's just say there's 5, and the average down payment is 10%, and they're $500,000 homes. So now you've got 5 homes where the loan amounts on average are going to be $450,000. So they will take out those loan dollars. They will buy those loan dollars, pre-purchase those loan dollars from the mortgage company at whatever rates are today. So if they want a 4.9% interest rate on that $2.5 million that they want to buy to cover those 5 homes, they will buy that money from the mortgage company today, and they'll pay the cost to buy it down from wherever the market is. So if a market on average, let's just say it's 7%, and they want to buy it down to 4.99, that's 2% lower than market. That might have a 5% cost, discount cost, prepaid interest on each of those deals. 5% on that $450,000 per home, that's a lot of money. That's $27,000, $28,000 per home. So they'll buy that $2.5 million needed. They'll prepay that $27,000, $28,000 per home to the mortgage company directly. And now they've got those dollars sitting there at a 4.99% interest rate that they can offer to those homeowners. There's some positives to that. There's some negatives to that. The positive is, to the builder, they can advertise low rates that bring people in, but it is very specific on the homes because they've got to close in a very specific amount of time. Those forward commitments are not lifelong. It's not like, hey, I've got $2.5 million until it's gone. I have $2.5 million until it's gone in a 90-day window. So it's only for spec homes. You won't find forward commitments on a home that's more than 90 to 120 days from closing, because they can't predict what that cost would be to charge the builder for buying it. There's a downside where if the market is improving, well, buying $2.5 million today at 5% cost, if it would be 4.5% on Friday, that builder just spent 0.5% more than they needed to. If it's 3% on Tuesday, they spent 2% more than they needed to. Right. So it's good in certain markets. It's good for certain reasons. But the reason it is very limited and sometimes only available on 2 homes is because of the time frame required. A builder will do that if a home has sat for a while. And again, the holding costs add up. So it's worth it to spend extra to get it off their books today. The consumer benefits because they get that lower interest rate.
Jared. Oh, sorry, I didn't mean to cut you off, Zach. But no. I just wanted to ask, for these first-time buyers who are feeling like maybe they missed the boat, it's not going to happen for them, rates are too high, homes are too unaffordable. What advice would you give to them if they have not completely given up hope and they still want to make this leap from renting into homeownership? So
I will tell you, and I'll be personal with what my wife and I did in our past when we were new homeowners, first-time home buyers, even our second and third homes. We've got big aspirations and dreams, and everybody dreams of the big house, the big yard, the pool, the playground, the white picket fence, but not everybody can afford that today. I will tell you that my advice would be to get with somebody like you guys. Look at the areas where you're seeing the greatest amount of appreciation. Historically, Texas is 4% over the last 100 years, but there are areas where there's rapid appreciation through growth, 10%, 15%, 17%. 8 years ago, We moved to Texas 15 years ago. We rented for the first couple of years. We bought a house. Then we moved to Wiley. Wiley at the time, 7.5 years ago, was at 15% appreciation. So we bought a house that we didn't love. It was a good house. Don't get me wrong. It met our needs. It had 3 bedrooms, 3 bathrooms, had a place for the kids, kitchen, but it was not our dream home. It was not.
Yep.
But we were in that home for 2 years because that 2-year period of 17% appreciation, that growth in value and the equity that we got from that house far surpassed our ability to save the same amount of money in the same amount of time. So my advice is be strategic. Don't compromise and say, hey, I'm going to just get a house that I can afford. Get a house where you have a plan for 1 year or 2 years. You're going to buy something that suits your needs. It might not be your dream home, but put a little bit of money into it. If it's paint it yourself. That's pretty affordable to do. If you've got little minor projects, do them or hire them out, but spend a little bit of money to make it nice. The appreciation when you sell it in 2 years or 3 years will give you the assets and the money you need to buy that dream house. Even if it's in an area where 3 years from now sales prices are a little bit higher, you're still going to outpace your ability to save the same amount of money.
Yeah. And I think that's why we're all such big fans of new construction, right? Absolutely. Is the market in those areas is it's a forced appreciation because builders are pushing pricing and then you have more people coming in. And the key on that is you just have to wait the builder out. You don't want to be selling while they're opening another phase.
Yeah.
or you might, be in a losing situation.
There's 2 parts to it. And my builders may appreciate or hate what I'm about to say, but in reality, you're right. Buying early in the phase, early in there, you're in the beginning where, yes, over the next 3 years, 4 years, sales prices are going to continue to go up. That's going to pull your appreciation up with it. And then some of the best deals are the last few homes in the community, because now it's man, I don't want to employ and staff a model home or a community where I've only got 1 or 2 homes left. Maybe they've been complete for a few months and now it's just holding costs and interest on the loan they took generally to build the home. You can get really good deals on the last 4 or 5 homes. And that's not to say those middle couple hundred aren't good, because the builders incentivize those. They're going to make it affordable for you and you still get to see the appreciation in it. But the best values are going to be the first 30 or 40, 50 homes and the last
5.
Yep. Yep. Yeah.
Yeah. No, all right. Quick one, really quick. Would you rather inventory or build? Like from a lending perspective, from a buyer's perspective, what do you prefer?
Honestly, I think that over the last 4 or 5 years, my opinion has changed. I would always be a proponent that, affordability wise, buy and build the house that is your dream house. If you can afford it, do it. My opinion has changed to spec home over the last 4 or 5 years, mostly market driven, because I would say that you know what you're getting in a spec home. You know exactly what it looks like. You don't have to make massive decisions that you may or may not regret later. There's not going to be any fight between you and your spouse about you wanted the black counters and we got the white. It is what it is. But also, you know what your payment's going to be. Coming 5 years ago, 4 years ago, people were building and being approved for that 3% rate you mentioned earlier. But over the year it took to build the house, rates jumped up to 5.5%. And a lot of people no longer could afford it. Or they just didn't, they were no longer in love with it. They were in love with it at 3% in that payment, but now it's not the same at this one. So I think there's a huge advantage in a spec home model where you know what you're getting. You know what the house is, you know what the payment is. Nothing's going to change in 60 days.
I agree. All right, guys. Any final thoughts, Megan? Final questions or anything for Jared? Jared,
I'm good. Thank you for joining us, Jared.
Absolutely, I appreciate it. Thanks for having me on.
We will link Jared's information down below if you have questions or you're wanting. Jared, can you tell us your preferred builder relationships? Can I ask you that?
Yeah. So we work with Beezer Homes in DFW, Long Lake in Houston, Pace Setter in both DFW and Austin. And then we've got a few others that are coming online in the next month or so. And I'll make sure to reach out and let you guys know what those are.
Let us know.
I will. And then of course, we've got some relationships with other builders. Like you mentioned, Zach, if something falls through or we've done stuff in the past for them, we have some relationships where we might not be who they recommend as you walk through the door, but we can pre-approve and get the same incentives if we send you over there.
Awesome. Yeah,
Yep.
no, we appreciate that. So I will put Jared's link if you have questions or you want to apply, get a pre-approval, talk to him. He is brilliant and we'll talk you through everything that you need to know about buying a home. So we appreciate you guys. Thanks for hanging out with us again today. As always, if you need help here in DFW or you're moving to our market, Megan and I would love to help, but we can't help unless you reach out. So contact information is always down at the bottom of the screen. So we will see y'all for our next one. Bye, y'all.
Awesome. Thank you, guys.
Bye.